9 assets that generate income. There are several types of income-generating assets ranging from real estate, stocks, savings accounts, certificates of deposit to private equity. Each of these will have its own pros and cons, which are important to keep in mind as you consider which will be best for your portfolio. As you review our income-generating assets list, try and consider the cost of entry, potential returns, level of involvement, and feasibility of each investment opportunity. Finding the right combination of assets to achieve your financial goals will be entirely up to you, but by doing your research you can help ensure you are prepared to make smart investment decisions. Here are some of the most common income-generating assets to be aware of. Real estate assets, stocks, savings accounts, certificates of deposits, private equity investing, peer-to-peer lending, building a business, farmland, annuities. Number 1. Real estate assets. Several real estate investing strategies can generate consistent revenue, however, one of the most common is investing in rental properties. This consists of purchasing a home or multi-unit property and marketing to tenants to earn rental income over time. Rental properties offer the opportunity to generate steady rental income over long periods of time. By hiring the right property manager, you can ensure your rental property runs smoothly, without a high level of involvement on your behalf. One of the most attractive perks of investing in rental real estate is enabling investors to increase their wealth without significant capital up front. Additionally, real estate investing can provide the opportunity to expand your portfolio more rapidly when compared to other investing opportunities. For example, you could purchase a single-family home to begin renting out. You could then use the income generated from this property to purchase another rental property, thus adding another income-generating asset and expanding your investment portfolio. There are a few different types of real estate to consider, ranging from a single-family home to an apartment complex. The property type is based on the number of units available, and depending on your investing goals, some may seem more attractive than others. For example, it is common for first-time investors to opt for duplexes, triplexes, or quads and live in a unit while renting the others. However, larger properties, meaning those with more units, typically signal larger amounts of capital required to get started and increased levels of involvement. If you are intimidated by the prospect of owning properties but still find yourself interested in real estate, REITs can be an attractive income-generating asset. Real estate investment trusts are similar to investing in stocks, but they are specifically real estate-oriented companies. Real estate investment trusts can specialize in apartment complexes, office buildings, storage units, or parking garages. Entrepreneurs who choose to invest in REITs will be able to work in the real estate industry without walking through the upfront costs and setup of acquiring properties. Number 2. Stocks. Stocks refer to investments in business equity and allow investors to generate income through several means, not the least of which are dividends. More importantly, dividends are rewarded over time and do not require much capital to benefit from. It is important to know the difference between investing in individual stocks and investing in mutual funds. Individual stocks represent the opportunity to buy single shares in a company to test out the industry. On the other hand, investing in mutual funds involves investing in different stocks across several companies. Because mutual funds are more diverse than individual stocks, they provide less risk. However, individual stocks can yield potentially higher results. If you are interested in investing in stocks, be sure to familiarize yourself with the stock market and get a better idea of the types of companies you may want to invest in. Among the best income-producing assets is large-cap dividend investing. Commonly known as the dividend aristocrats, these blue-chip companies in the S&P 500 are known for consistent increases in dividend payouts. Dividend stocks derive from companies that are well past their growth state, meaning they exhibit much more stability than younger, growing companies. While dividend investing can be a reliable income-producing asset, several tech companies, including the internet and biotech, commonly do not pay dividends. Instead, most of their retained earnings are reinvested back into their company to maintain further growth. Number 3. Savings accounts. Savings accounts are one of the most straightforward assets that generate passive income. Opening a savings account at your local bank will allow you to earn revenue from the interest your own money accrues over time. Depending on the type of account and interest rate, the potential income will vary. Typically, investors can expect between 0.01 and 0.30% back on the amount put into the savings account. While low interest rates may result in lower returns compared to other income-generating assets, savings accounts do offer the benefit of liquidity. Investors will often be able to access these funds on short notice. There are also high-yield savings accounts, which differ slightly from traditional savings accounts because of their high interest rates. However, they are often only found at online banks, which leads to some downside. Investors may only be able to add money to the account through online transfers, and any support issues will often have to be dealt with online or over the phone rather than in person. The trade-off between convenience and higher interest rates is something to consider as entrepreneurs research savings account options. Number 4. Certificates of deposits. Certificates of deposits, CDs, are considered time deposits and can be thought of similarly to savings accounts. Investors invest a set amount of money and earn income through interest accrued over time. The main difference between CDs and savings accounts is that CDs will require set amounts of time before investors can access the funds without penalty. Due to the required time frame, CDs will often have higher interest rates when compared to savings accounts. For example, investors may be able to find a 5 to 7 year CD with interest rates up to 2.5%. While the time frame may be longer than expected, one of the great things about investing in CDs is that there are not income minimums to invest. This makes CDs one of the more accessible types of assets to invest in. Number 5. Private equity investing. Private equity investing refers to the practice of investing in private companies, many of which are in the early stages of development. This can represent an attractive opportunity, particularly if you find yourself in the midst of the next successful startup company. While private equity investing can offer attractive profits, there are several factors to consider. The most obvious is that it will take research on your part to identify the right companies to invest in. It is not uncommon for private companies to fail in their first few years, so mind due diligence as you look for businesses to invest in. There is also a lockup period for private equity investing. This refers to the time frame when investors will not be able to tap into the funds they invested. Lockup periods can range anywhere from 6 months to 10 years, depending on the company at hand. As you look into private equity investing, be sure to consider how a lockup period could potentially impact your finances. Number 6. Peer-to-peer lending. Peer-to-peer lending replaces the role of banks and helps denied borrowers receive a loan at lower rates than large-scale financial institutions. Peer-to-peer lending has now become a multi-million-dollar business and a viable income-generating asset. According to leading peer-to-peer lenders, investors have the opportunity to make 5 to 7% in annual returns. As with most income-generating assets, peer-to-peer lending has moderate risk as some borrowers are known to break their contract obligations. Number 7. Building a business. Among the best income-generating assets is a particularly interesting investment idea: opening your own business. This could be whatever you want it to be, a product for sale on Etsy, or perhaps your own real estate investing business. Building a business is a great way to increase your cash flow while also pursuing something you are interested in. Perhaps the biggest benefit is that you can devote as much, or as little, time as you want to this project. It could start as a side project to supplement your regular income and one day turn into your main focus. There are numerous business options available that could be of interest to you. Perhaps some of the most common are opening franchises, whether for restaurants or gyms in your area. As you might expect, these businesses can take a lot of capital, time, and work before operating successfully. An alternative business idea could be selling any of your skills online. For example, if you have experience in graphic design or copywriting, you could pursue freelance opportunities until you have enough clients to start your own business. Another unique idea could be to buy and sell websites through platforms such as Flippa.com. Building a business of your own can ultimately turn into an excellent income-generating asset. It all depends on how much work you can put into it. I recommend researching new ideas, looking for a need in your market, and then finding a mentor to help with any questions you may have in the beginning. This route will take time to get started, but it could be a great way to pursue your passion while increasing your overall income. Number 8. Farmland. Farmland is among the best income-generating assets for several reasons. Unlike many investment types, farmland does not experience the same level of volatility. Farmland has a low correlation with the stock market because it provides a necessary resource, food. For this reason, the demand for farmland has been relatively consistent throughout history. Investors interested in benefiting from this asset can take one of two approaches. First, you can purchase land directly and lease it to a farming company. This strategy will require research to ensure the land is in the right place and have a consistent renter. Another approach is by investing in an REIT or crowdsourcing platform that focuses on farming and farmland. Keep in mind that you will want to research these companies before investing, as there may be fees associated that could undermine your income potential. Number 9. Annuities. Annuities are essentially a lump sum investment paid to an insurance company that is paid back to the investor over a period of time with a return on investment. This strategy is popular with retirees as the funds can only be withdrawn after the age of 59.5. If you liked my video, then subscribe to channel, so that you do not miss any of my videos. Thank you.